Welcome to The Explainer. This is the series where we break down really complex business topics into clear, actionable insights. Today, we are diving into a huge one, a question that's on pretty much every founder's mind. How in the world do you get the funding to turn your vision into a reality? We're going to look at what investors are really looking for.
Okay, so let's get right into it. You know, so many entrepreneurs, this is where they start. They have this product, this idea, and they are so incredibly passionate about it. They believe it's a game changer, and that the only thing standing between them and world domination is just a check. They think the whole battle is just getting in front of the right person.
But right there, in that one assumption, is a massive disconnect. See, founders are naturally obsessed with their vision, right? The idea, the product, how it's going to change everything. Investors, though, they're playing a totally different game. They're focused on the investment, the math behind the return, and the eventual exit. And bridging that gap, that's the key to getting funded. To get that yes, you have to start thinking like an investor. You've got to understand their equation, their business model, because for them, this is a high-risk, high-reward numbers game. It isn't personal, it's just math. I mean, just look at these numbers. This quote, yeah, it's from a while back, but it makes a point that's absolutely timeless. Venture capital only backs a tiny, tiny fraction of new companies. And it's not because those other hundreds of thousands of businesses are bad ideas. Most are probably really solid companies. They're just not the right kind of investment for a VC.
So why are they so incredibly selective? Well, it's because of this, the power law curve that basically runs their entire industry. VCs go into this knowing that most of their bets, like 60 to 70%, are probably going to fail, go completely to zero. A few will do okay, moderate successes, but the entire success of their fund, their ability to pay back their own investors, it all rides on less than 10% of their deals becoming these massive out-of-the-park home runs.
Exactly. They literally cannot afford to put money into a business that's just going to be a nice, profitable, steady company. Now, for a founder, that sounds like a fantastic outcome. But for a VC, it doesn't move the needle. It doesn't return the fund. They need businesses with the potential for explosive, almost unbelievable growth. They are swinging for a grand slam with every single check they write.
So what does that explosive growth even look like? Well, investors often have these mental models, these shorthands, to see if a company even has a shot at it. And one of the most famous is this one, T3D2. It stands for triple, triple, double, double. It means they're looking for a company that can triple its revenue for 2 or 3 years straight, and then double it for the next 2. It's a quick gut check for the kind of trajectory that leads to those 10x plus returns they need.
And that brings us to the absolute crucial point. When you walk into that pitch, your job isn't just to prove you have a good idea. It's not even to prove you have a solid business. Your job is to prove you have a venture-backable business, one that fits their super specific, high-risk, high-return model. You have to convince them you are that potential grand slam.
Okay, so you get it. You need to show them you're a grand slam. But how do you actually do that? How do you communicate it? Let's break down the blueprint for a pitch that actually speaks the language investors understand. It all starts with changing how you think about your business plan and your pitch deck. These are not just a request for money. They are a test of how serious you are, how professional you are, and frankly, how competent you are as a leader who can be trusted with millions of dollars.
And that test follows a very specific logical structure. Investors have seen thousands of these, and they expect to see this narrative. You have to nail each piece. Here's the problem. Here's our unique solution. Here's why the market is huge. Here's why we are the team to win it all. And then here's the financial roadmap and exactly what we need your money for.
Now, beyond that basic structure, what investors are really digging into, what they're stress testing, are two things: the quality of your plan and the quality of your team. A credible plan is not just a bunch of hockey stick charts pointing up and to the right. It has to show real, rigorous thinking. It's about showing that you've moved past just having an idea and that you now have a series of testable hypotheses about your customers, your market strategy, and your financial model. It proves you know how to build a business, not just a cool product. But even the most brilliant plan in the world leads to what is arguably the single most important factor for any investor: the team. There's that classic saying in VC, we bet on the jockey, not the horse.
A great idea with a team that can't execute is completely worthless. Investors are betting on you, on your grit, your experience, your resilience, and your ability to navigate the absolute chaos that comes with building a startup.
So let's say you do it. You pass the tests, you've proven you've got a venture-backable business, a killer plan, and an amazing team. You get the S. Well, now the conversation shifts to structuring the deal, and this is where you come face-to-face with the classic rich versus king dilemma.
Okay, so you can see here how a standard VC deal works. And honestly, it's designed to manage their risk. If things go bad, a low exit, the VCs get their money back first. It's downside protection. If it goes okay, a moderate exit, they get their investment back plus their share. But if it's that grand slam we talked about, their special stock converts to regular stock, and everybody's incentives are perfectly aligned to make the final number as big as possible.
And this gets to the fundamental trade-off, the big decision every founder who takes VC money has to make. As the scholar Noam Wasserman says, you have to decide, do you want to be rich or do you want to be king? Venture capital can absolutely help you get rich by scaling like crazy, but that path always comes at the cost of control. And they maintain that control through very specific things written right into the deal. They'll take seats on your board, they'll get veto rights over huge decisions like selling the company, and yes, they will often have the right to replace you as CEO if you aren't hitting those crazy growth targets. Again, it's not personal. It's their way of making sure the company stays on that high-growth path their fund depends on.
So, after this peek behind the VC curtain, what are the big actionable takeaways? What do you do with all this? And maybe the biggest question, are you truly built for this journey?
It really just boils down to these 4 critical mindset shifts. 1. Think like they do. Understand their math. 2. Prove you're a venture-backable outlier, not just a solid business. 3. Treat your pitch like the serious test of competence that it is. And 4. Be brutally honest with yourself about that rich versus king trade-off. Getting these 4 things right won't just make you more fundable, it will make you a much smarter founder.
In the end, it's so important to remember that venture capital is rocket fuel. It is incredibly powerful, but it is designed for a very specific type of vehicle, aiming for a very specific destination. So the most important strategic question you can ask yourself is this: is your venture that rocket ship, or is it a different kind of vehicle, built for an equally great but very different road to success? Thanks for joining us on The Explainer.